There's many times where I go in, I'm excited, the stock is perfectly set up for what I want to do. I go in and the strikes have zero open interest or zero volume. And it's like, oh man, all right, move on. You can't force these trades.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week.
Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today we are on options trading mistake number 5. This is trading illiquid options. Now, this is part of our options trading mistake series. And, I'm basically taking Ally Invest video and I am putting in my own spin based on what they're saying. Now, I'm watching these cold, so I really honestly don't have any idea what they're about to say. But really interested in looking into this because this is something that I've dealt with in the past, and it's certainly in my trade criteria to make sure that the options I trade are liquid. So I'll share more about that as we go through. So let's get started here.
Trading in illiquid option markets. Stocks have a lot more liquidity than options do. And why is that? Because when you look at the stock market, you have one stock to trade. In the options market, you have many different expirations, you have many different strike prices.
So yeah, he's totally right. So when you look at something that maybe it trades, well, I'll just give you an example. So I trade a lot of different stocks out there, and I really like to trade options, obviously. But one of the things that is in my step-by-step criteria is, let's say it trades 1 million shares. I need to make sure that the strike that I'm looking to trade, meaning the week that it expires, and the strike that I'm actually wanting to trade, not just, any random strike, but the actual strike that I'm wanting to trade, is trading at least 300 contracts. That is where my minimum is at. Now, if it's like 280, I might go with that. But if it's like 220, no, I'm not interested. 300 is pretty much my minimum. And the reason I do that is because of liquidity. You want to be able to get in and you want to be able to get out. And you can't get in and you can't get out unless someone else takes the opposite side of the trade. And the only way they're going to take the opposite side of the trade is if you have a liquid contract. There's many times where I go in, I'm excited, the stock is perfectly set up for what I want to do. I go in and the strikes have zero open interest or zero volume. And it's like, oh man, all right, move on. You can't force these trades. And you'll also find that the bid and ask spread will be pretty wide on those, maybe even 100, or let's call it $1, maybe $1 or $2 or $3. I've even seen up to $5 wide on an illiquid strike like that. And you're going to be paying that difference. You're going to be paying it to get in, and you're also going to be paying it to get out of that trade if it has a wide bid-ask spread and low volume. This is really, really critical. I'm glad that they're talking about this because this is one of those things that doesn't get a lot of attention until you become a trader and you realize how important it is. Now, I'll tell you a story. I was trading earnings. This is one of my first earnings trades. I don't trade earnings anymore. And the traditional way to trade earnings with options is to buy or sell an iron condor. And when you do that, you're selling an out-of-the-money put spread and selling an out-of-the-money option, a call spread. And basically, you're boxing in the trade. The idea here is that the implied volatility is so high, you can sell it for so much that after earnings, if it doesn't move, which obviously that's a big if it doesn't move or stays inside the expected range, then the implied volatility should collapse and you should make a really nice, fast, easy profit. The issue with that is liquidity. So I was trading on AKAM, which is like the only time I've ever traded that stock. Didn't know anything about it, really didn't even know about the liquidity. And earnings happened. The next day, I was trying to get out. I was putting in limit orders. Like, let's say I sold it for $1 and I was trying to get out for 50 cents. 50 cents wasn't happening. 60 cents wasn't happening. 70 cents wasn't happening. And I'm like, this should be a good trade. Why is this not working? So the stock price was inside of my iron condor. It expired in like that day. So I had to get out if I wanted to keep the profits before anything happened. And so I was like, you know what? Market order. And when I got filled, it became a huge loser. It went from being sold like $1 to being filled to close at like $3. So what would have been a great, nice, $50 per contract profit there turned into like a $200 per contract loss because it was illiquid and I used a market order. Neither of those two things I do now. And I hope that you can understand why I'm sharing that so that you also don't do the same. Now, back to the video.
So let's get a handle on exactly what liquidity means when we're talking about the stock or options marketplace. Liquidity, simply put, is all about how quickly a trader can buy or sell something without causing a significant price movement.
That's interesting. Without causing a price movement. I don't know about you, but I don't trade enough size to be worried if I am or am not going to cause price movement. In fact, I was listening to some of the Market Wizard books recently while I'm outside walking on my on Audible, and they were talking about how when they trade with giant size, there can be times where their trades that they're putting on are moving the market. That's not the case in my portfolio. Maybe it is with yours, but I'm kind of surprised by that definition there. Let's see what else he says.
A liquid market is one that has ready and active buyers and sellers at the current price. So if a stock is illiquid, the options are going to be. So I'm definitely not going to trade options in illiquid stocks. So let's just talk about an example. Let's look at an option contract that is trading with a bid price of $2.50 and an ask price of $3. The ask price is the price at which you can buy the stock at, and if you bought it and instantly sold that underlying, you would be selling on the bid price. And in this instance, we have...
Yes, that's what I was mentioning a minute ago, is you're going to have to be paying for it on both sides if you are finding something that's really wide, right? So you'd be buying it at $3, and if you immediately had to sell it, you'd have to sell it at $2.50. So you've lost basically, let's say a $2.75 is the midpoint. You've lost $25 getting in, and you've lost another $25 getting out, and that sucks. And like you said here, it's like 20% of the initial investment here if you were, having to go that wide. That's why you want those really tight spreads, exactly for this reason.
A 50-cent difference between the bid and ask. Now, that's common in the options marketplace, especially if you're not trading extremely liquid stocks. So in this instance, we're talking about a 20% difference between the buy price and the sell price. So how can we trade smarter when we're thinking about option trading in general? We want to check volume and we want to check open interest on...
Yes, now this can be a little deceiving, and he may go into this too. Open interest is the number of contracts that people are actually like trying to trade, where volume is the number of executed points. And I think open interest actually should be a little bit more of the indicator that you go with, because that means there are people who want to take the trade. Versus, like, let's say you're getting in right after the market opens. It only trades 300 contracts like a day or whatever. It might only show like 2 or 3 or 5 for volume, where your open interest may be into the hundreds. And big distinction here, like open interest is people who want to trade with you. Volume is the number of transactions that have taken place
on the option contracts that we're buying. Now, this is just a general rule of thumb, but if you would like at least 40 times the number of contracts you want to trade as the open interest.
That's interesting. So he's saying if you were to trade one contract, you would like to have at least 40 as the open interest. Well, I must be going for stocks that are way too liquid then if I have at least like 300 to start with, right? So yeah, I think you should go with a little bit higher number for open interest personally.
For example, you want to trade 10 contracts, you want to see at least open interest of 400 as far as the option strike line is concerned. Now, also, other little things you want to think about.
Okay, I can get behind
stock, that. A lot of times are not very popular with options. If it's under $5, just buy the stock. Just buy the stock outright. It's a lot easier to get in.
All right, personally, I don't trade under $5 stocks. You know, there's a whole world of penny stocks out there, and it's just not where I want to be. They're cheap for a reason. I think of it that way. In fact, if you get nothing away from this podcast today, just think about this. When a stock is cheap, it's cheap for a reason. It's because not a lot of buyers want to be there, right? Think about Tesla, how it's many, many hundreds of dollars a share. And then they do a share split, and then it immediately runs up to many, many hundreds of dollars a share. It's because people want to be there. There are buyers. If it's under $5, there's not a lot of people who are wanting to buy this and think it's valuable. So
in and out of the stock than a very tiny or small strike option contract. And bottom line is, if you continue to trade option contracts with wide bid-ask spread, it's very hard to make up the cost of doing business. So we want to go out and look for liquid underlyings. A lot of people that will trade options will stick to 5, 6, 7 different stocks that they like to follow and they like to trade.
Yeah, I don't think that's crazy. I mean, if you find a stock that you like to trade, then just stay with it. Me personally, I am open to the entire world of stocks out there as long as they are trending up. I'm interested in trading with them. I don't have a pet number of stocks.
And they're usually popular stocks, including some that are indexes like the S&P 500 index, the Dow Jones Industrial Average Index. Those type of underlyings usually have a lot of liquidity, and it takes this piece of the puzzle out of option trading. Well, that's it for today.
Yeah, that makes a lot of sense. If you're going to trade something like the SPY, which is the S&P 500 ETF, that makes a lot of sense to do that. So, hey, listen. So here's the key takeaways here. You do want to be in something that's liquid. The main reason is you are going to pay for illiquidity on getting into the trade and getting out of the trade. Whereas if you're getting into something that has a really tight bid-ask spread, has a lot of people that want to trade with you, you're going to be filled at favorable prices. Whereas if there's not a lot of liquidity, you may not be filled at favorable prices. Or even worse, you want to get out of a trade and nobody wants to take the other side of it, and then you're stuck. That's actually one of the huge reasons I don't trade penny stocks. I've heard so many horror stories of people who put all of their account into something that's, let's call it 10 cents, and it moves up to 11, and they're like, I'm out. I made 10% on all this money, and there's no one to fill it there. And it goes up to 12, still no one to fill it. It goes up to 13, still no one to fill it. And the only time they're actually able to get out is when it's below like 9, 8, 7, 6 cents. Either way, that's one of the main reasons why I don't trade penny stocks. But it should be an example as to why you should find liquid underlyings. Don't worry so much about the number of shares traded. If it's 900,000 or 10 million, either way, unless you're coming in with 900,000 shares to trade, you're not going to have an issue getting filled with that. Look for at least, like he was saying there, 10 times the number of contracts you're looking to trade. And my rule, my bottom rule, no matter how many contracts you're trading, is 300 contracts of open interest every single time. Don't go less than that, because that's the very minimum you need to start getting filled. So hey, listen, if you found this helpful, make sure you hit that like button and then share it with somebody who would be interested in also learning about trading with options and options trading mistake number 5, trading illiquid options. And be sure to check out the rest of the options trading mistakes playlist that we have here, and be sure to like, subscribe, and enable notifications. That way we never miss any of the tools, tips, and tricks that we upload every single week to help you trade fast and trade smarter. I'll see you on the next episode.
Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning on how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.